Gold just fell 26% from its all-time high, and the same month that happened, China bought more of it than almost any other month in 3 years. Think about that for a second. If gold were actually a bad investment right now, if the smart money believed the top was in, you would expect central banks to be quietly getting out. Instead, the People's Bank of China just logged its 20th straight month of gold buying. 20 months. That's the longest streak since at least 2015. And they did it in June, while the price was still down double digits from the peak. So here's what's actually happening, why it's happening, and what it means for your money. Because there's a pretty basic rule in investing that most people ignore. You don't judge whether something is a good buy by how it makes headlines. You judge it by what the people who move billions of dollars are actually doing with their own money. And right now, those people are buying the exact thing that retail investors are being told to be scared of. Let's start with the basics, because I want everyone watching this to actually understand what's going on, not just nod along. Gold hit an all-time high back in late January of this year, spiking above $5,500 an ounce during a stretch of serious tension between the US and Iran, plus a weakening dollar and a wave of trade uncertainty. That's a big number. For context, gold spent most of the last decade under $2,000, so the run to 5,500 was historic, one of the fastest, sharpest gold rallies in modern memory. But markets don't move in straight lines. After that spike, gold rolled over hard. It fell all the way down to around $4,000 at the low point of the second quarter, roughly a 26 to 27% drop from the peak. As of this week, gold is trading in the low 4,000s, somewhere around $4,100 to $4,200 an ounce, depending on the exact hour you check. Silver, meanwhile, is sitting close to $60 an ounce. Now, a 26% drop sounds scary if you're the kind of person who bought gold coins at the top and you're watching the number go down on your screen. But here's the thing that most people miss. A price drop isn't automatically bad news. It depends entirely on who's on the other side of the trade. If retail investors are panic selling into a drop and a completely different class of buyer, one with far more information and far longer time horizons, is aggressively accumulating during that exact same drop, that's not a warning sign. That's a signal. And that's basically what a bond is a good example of, since I know some of you aren't familiar with the term. A bond is basically an IOU. You lend money to a government or a company, and they promise to pay you back with interest over time. I bring that up because bonds are the other side of this whole story, and we'll get to why in a minute. Okay, reason number one. Let's talk about who's actually buying this dip, because the names matter. The People's Bank of China has now bought gold for 20 consecutive months. In June alone, they added about 480,000 troy ounces, just under 15 tons, which was their largest single-month purchase since 2023. China's total gold reserves are now sitting around 23 to 2,350 tons, depending on which report you're reading. Because remember, official numbers are considered a floor, not a ceiling, when it comes to central bank gold. More on that later. Here's the number that really puts it in perspective. China currently holds less than 10% of its foreign exchange reserves in gold. The United States, by comparison, holds around 70% of its reserves in gold. That's not a typo. 7 times more proportionally. So when people say China's already bought so much gold, surely they're done. The actual math says the opposite. They have a lot more room to run if they're trying to close that gap. Reason number two, China isn't alone. Poland has quietly become one of the most aggressive gold accumulators on the planet, now holding around 614 tons, and they've been leading global central bank purchases for multiple months running. In May of this year, central banks collectively bought a net 41 tons of gold, with Poland and China as the two biggest drivers. In the first quarter of the year, central banks bought 244 tons total, a 17% jump from the prior quarter. And this has been the pattern since 2018. Central banks accumulating more than 1,000 tons of gold a year almost every year, through multiple different presidents, different Fed chairs, different global crises. This isn't a reaction to one headline. It's a multi-year coordinated repositioning. Reason number three, and this is where it gets interesting. The World Gold Council itself has said, in its own reporting, that official central bank purchase numbers likely represent an undisclosed floor, meaning the real total is probably higher, and some analysts think it could be several times the reported figure, especially for countries like China. Why would a central bank hide how much gold it's buying? Think about it from their side. If you're a government trying to accumulate a strategic asset over years without spiking the price against yourself, the last thing you want to do is announce your shopping list in advance. You buy quietly, through intermediaries, through multiple channels, and you let the official number trickle out later, if at all. That's not a conspiracy theory. That's just how any large buyer in any market tries to avoid moving the price against their own position. Reason number 4. Look at what they're selling to fund these purchases. For roughly 50 years, the standard playbook for central banks was the exact opposite of what's happening now. Take extra dollars, park them in US treasuries, effectively lending the money back to America. That was the deal that underpinned the whole global financial system since the 1970s. What we're seeing now is a slow but real reversal of that pattern. Central banks are trimming treasury exposure at the margins and rotating a meaningful slice of those reserves into gold instead. China's foreign exchange reserves actually dropped by about $26 billion in June, even as its gold holdings grew. That's not a coincidence. That's a rebalancing. Now, before we go further, and I promise we're getting to the historical parallels in a second, let me tell you something that's been sitting quietly in the background of all of this. The Fed itself just changed its own playbook. Under the new Fed chair, Kevin Warsh, the Federal Reserve broke with decades of tradition and stopped publishing its personal rate projections. No more quarterly dot plot telling markets where each policymaker thinks rates are headed. For over a decade, that dot plot was one of the most closely watched documents in all of finance. Traders built entire strategies around decoding it, and now it's just gone. Which means the market has less forward guidance from the Fed than it's had in years. At the exact moment, inflation, oil prices, and geopolitical tension are all elevated at once. Uncertainty about the Fed's next move is exactly the kind of environment where gold historically does well. Because gold isn't a bet on any one company or currency, it's a bet on the idea that paper promises about future value can get shaky. Okay, now hold on. You might be thinking, if central banks are buying so aggressively, why did gold crash 26% in the first place? Doesn't that prove the smart money got it wrong, or that the rally was overextended? That's a completely fair question, and here's the honest answer. Central bank buying doesn't prevent price drops. It's not a floor that stops all volatility. It's a long-term accumulation pattern that plays out over years, not weeks. Gold ran up incredibly fast into January, partly on genuine geopolitical fear, and fast moves like that almost always give some of it back once the immediate crisis cools. Traditional financial theory also says rising or stubbornly high interest rates should hurt gold because gold pays no interest. So when rates stay elevated, some money naturally flows toward bonds and cash instead. Both of those forces were real, and they explain a chunk of the pullback. But neither of them explains why central banks kept buying through the entire drop. If this were purely a bubble deflating, you'd expect the biggest, most sophisticated buyers to be selling into the decline, not adding to their positions every single month on the way down. The fact that they didn't is the whole story. Let's zoom out to history for a second, because this isn't the first time the world has quietly repriced what money actually means. Go back to August 1971. President Nixon goes on television on a Sunday night and announces that the United States is suspending the dollar's convertibility into gold. Up until that moment, the entire global financial system, since the end of World War II, had been built on the idea that $35 would always get you 1 ounce of gold. That was the anchor. Foreign governments could show up with dollars and demand gold in return. But by 1971, the US had printed and spent so much, funding the Vietnam War and a wave of domestic programs, that there wasn't nearly enough gold in Fort Knox to back all the dollars floating around the world. Foreign central banks knew it. They started quietly asking for their gold back. And rather than let the vault run dry, Nixon just shut the door. He ended the whole system in a 10-minute address over a weekend, so markets couldn't react before it was already done. What happened next? Gold, which had been fixed at $35 for decades, was suddenly free to trade at whatever the world decided it was actually worth. Within a decade, it went from $35 to over $800 an ounce at the 1980 peak. People who held cash and did nothing watched inflation eat their savings alive throughout the 70s. People who held real assets, gold, land, hard commodities, came out the other side in a completely different financial position. The lesson wasn't gold always goes up. The lesson was when the people running the monetary system quietly change the rules, the ones paying attention move first, and everyone else finds out last. Now fast forward to 2008. The financial crisis hits, Lehman Brothers collapses, and the Federal Reserve responds by slashing interest rates to basically zero and printing money on a scale nobody had ever seen in peacetime, what we now call quantitative easing. At the time, plenty of serious economists warned this would trigger runaway inflation. It took a few years, but gold responded almost exactly the way you'd expect. It roughly tripled between 2008 and its 2011 peak, as investors who understood what massive money creation does to a currency's purchasing power moved to protect themselves early. The people who waited until the headlines caught up, until it was obvious to everyone on the evening news, bought in near the top of that cycle, right before a long, grinding decline through the 2010s. Same pattern as 1971. The informed money moves quietly and early. The crowd moves loudly and late. Which brings us to a simple physical analogy, because I think this makes the whole thing click. Picture a department store that's about to have a massive clearance sale, but only the store's own employees know the sale is coming. What do the employees do? They don't panic sell the inventory they already have. They quietly buy more of the good stuff at full price before the public even knows a sale is coming, because they know demand is about to spike. Now picture that same store, except this time prices actually drop 26%, a real visible discount, right in front of everyone. What would the smartest shoppers in that store do? They wouldn't run for the exits, complaining the discount means something's wrong with the product. They'd fill their carts. That's essentially what central banks have been doing with gold. They're not reacting to a discount with fear, the way an anxious retail buyer might. They're treating a lower price as an opportunity to add to a position they were already planning to build for years, a position tied to reserve diversification, not to next month's headline. Hold that analogy, because we're coming back to it. Let's talk about what the institutions are actually doing right now, in real time, beyond just the central bank tonnage numbers. The Bank of Korea has been exploring gold ETF exposure as a way to diversify its own reserves, a notable move for a country that has historically kept a very light gold allocation. Chile and Guatemala, two countries not typically associated with major gold accumulation, have started showing renewed interest in building gold reserves, according to World Gold Council survey data. And in that same survey, 89% of central bank respondents said they expect global gold reserves collectively to keep growing over the next year, not shrink, grow. That's not a majority. That's close to a consensus among the people who actually run this system. Meanwhile, on the flip side, you've got a handful of countries selling, Turkey, Russia, and Azerbaijan's state oil fund among them. But when you look closely, that selling has largely been described as liquidity management, things like gold swaps to raise short-term cash, not a strategic bet against gold's future. There's a real difference between a country selling gold because it needs cash flow this quarter and a country selling gold because it's decided gold is a bad long-term asset. Almost none of the sellers fall into that second camp. And here's a detail that connects back to the clearance sale analogy. Remember how I mentioned that official buying numbers are likely understated? That's not just China. The World Gold Council's own methodology explicitly builds in an estimate for undisclosed purchases across multiple countries, because large buyers everywhere have an incentive to accumulate quietly rather than loudly. So when you see a headline number like central banks bought 41 tons in May, the honest way to read that is at minimum 41 tons, with the real number almost certainly higher. So let's do the pass everybody's actually here for. What does this mean for the three big pieces of the picture? Stocks, gold, and the dollar. Start with stocks. There's a well-known market valuation gauge. Some people call it the Buffett indicator, market cap relative to the size of the economy. And on an adjusted basis, it has now crossed above 100% exactly 3 times in the last 70 years. The peak of the dot-com bubble in 2000, the everything bubble peak in late 2021, and right now in 2026. In both of the previous two instances, the stock market dropped somewhere between 25 and 47% from peak to trough, and it took anywhere from 2 to 13 years to fully recover. That doesn't mean a crash is guaranteed tomorrow. It means the historical base rate for what happens after valuations reach this level is not exactly comforting, and it's worth knowing that going in, whatever you decide to do with that information. Now, gold. Under traditional theory, a higher rate environment should be a headwind for gold, because gold pays no yield, so money can rationally rotate toward interest-bearing assets like bonds instead. That's a real risk, and it's honestly part of why gold pulled back as hard as it did earlier this year. But that same traditional theory doesn't have a great answer for why the single largest, most sophisticated buyers on the planet, sovereign central banks, have ignored that signal for 20 straight months. When the textbook says one thing and the biggest players in the market do the opposite for nearly 2 years running, that's worth paying more attention to than the textbook. And the dollar. This is really the through line connecting everything we've talked about. Central banks trimming treasury exposure, even modestly, while stacking gold, is a slow vote of reduced confidence in the dollar as the world's one dominant reserve currency. Not a vote that the dollar is about to collapse, nobody serious is saying that, but a vote that having all your eggs in one currency's basket is starting to look like an unnecessary risk to the people whose entire job is managing risk at a national level. So let me tie this all together. Gold dropped 26% from its January peak. That drop is real, and traditional theory can explain a good chunk of it. A fast prior rally cooling off, sticky interest rates pulling some money toward yield instead. But through that entire decline, the institutions with the most information and the longest time horizons on Earth, the People's Bank of China, 20 months of consecutive buying, Poland, 614 tons and climbing, central banks collectively adding over 1,000 tons a year since 2018, didn't step back, they leaned in. That's the clearance sale employee filling their cart while the discount sign is still up, not running out the door. This is genuinely what's happening. Nobody knows exactly where gold goes from $4,000 over the next 6 or 12 months. Anyone who tells you they know for certain is selling you something. But the people who run the actual monetary system of the world are positioning themselves for a specific outcome, deliberately, patiently, and largely without fanfare. The question isn't whether that's scary. The question is whether you're paying attention to what they're doing, or only to what the price chart did this week. If you want a deeper breakdown of what all this means for your own retirement savings specifically, how to think about diversification when the institutions themselves are diversifying away from a single currency, there's a free guide on protecting retirement savings linked right below this video, and there's a QR code on screen too if that's easier. It walks through the exact mechanics of what we just covered applied to an actual retirement account. Anyway, back to it. One more thing worth mentioning before we wrap up. If you've got $100,000 or more sitting in a retirement account and you want to actually talk through how something like this applies to your specific situation, we host a free one-on-one educational web conference where you can ask questions directly instead of just watching a video and guessing how it applies to you. No pressure, no sales pitch, just a real conversation about your own numbers. The link for that is below as well. Okay, back to the actual analysis. Here's the honest summary. A 26% gold pullback looks, on the surface, like a warning sign to stay away. But when you look at who's actually buying into that pullback, the same institutions that have accumulated gold for 8 straight years, that are running the longest central bank buying streak in over a decade, that are quietly rotating away from the one asset that's anchored the global system since 1971, the picture changes. This isn't a story about a number going up or down this week. It's a story about which direction the largest, most careful money on the planet is walking, slowly, deliberately, one purchase at a time. If you found this useful, there's more where this came from, and I genuinely appreciate it if you stuck around for what's next. Don't forget to check the guide and the QR code below if any of this applies to your own retirement planning. I hope you have a wonderful rest of your day, and I'll see you in the next one.